Hello and welcome to Nordnet. Today we are joined by John Hamilton, the CEO of Panoro Energy. Panoro Energy is an international independent oil and gas company headquartered in London with production, exploration and development asset in Africa. The company was established back in 2009 and its shares are listed on Oslo Stock Exchange. My name is Roger Berntsen. Before we move on, it's important to know that this session shall not be considered as investment advice. Our only goal is to learn more about Panoro Energy as a company and its underlying industry. So, John, you will now take us through a short presentation of Panoro Energy. Thereafter, we'll wrap things up in our Q&A session.
Thank you, Roger. And welcome, everybody. Welcome to all our shareholders. I know we have a number of shareholders, Nordnet shareholders in our share. This is my third time here on the Nordnet over the past 4 or 5 years, so I've been a constant presence here and very much valued the opportunity to speak directly to our shareholders and to those of you that are following us. I'm John Hamilton, Chief Executive Officer of Panoro Energy ASA. And I'm going to take you through very briefly some slides which give you an update. Our company is much transformed since the last time I presented here. I'd like to take you through some of those changes and where we see the future as well. So I'm going to take you through some slides now. As a reminder, we are a Oslo Børs listed E&P company. We focus only on oil and gas in Africa. We are the only E&P company listed on the stock exchange, the Norwegian top exchange, focused exclusively on Africa. We're from north to south, from Tunisia all the way down to South Africa. Our core production operations are in the middle of Africa in Gabon and Ekvatorial-Guinea. Ekvatorial-Guinea being our most recent addition, which now comprises about 60% of our production. We have a market capitalization of approximately $300 million, which is a little bit under 3 billion kroner at the moment. We have net reserves of around 36 million barrels. Importantly, in the blue box, you can see we have contingent resources of around 33 million barrels. And what this means is these are resources that are on the bench, so to speak, will be called into the field when the reserves have been produced. So it gives you an idea of the long-term nature of our business. We exited last year at approximately 8,500 barrels a day, so we are a substantial oil and gas producer in Africa. There's a lot of talk around ESG and stakeholders and everything else, particularly in the oil and gas business. Now, what I think is important is to talk a little bit about our broader stakeholder list. In the middle, we have, of course, you, our shareholders. We have a huge shareholder base here. It's predominantly Norwegian, although we have also shareholders in the United States, in Africa, and in Europe and the UK. We have 6,500 shareholders. We have a very, very strong top of the register with strong long-term institutional and family offices investing for the long term with Panoro. And we have very, very good trading liquidity, which for a company like Panoro is very important. You can trade in the stock, you can trade out of the stock. So this is a very important stakeholder. We also have financial stakeholders on the right, which are our lenders. These are the people that provide us with the financial capacity to do some of the transactions that we've done. But on the left is what kind of gets ignored sometimes. And again, in the ESG world, oil and gas companies can often be portrayed as the bad guys. But in fact, when you look at energy security, and economic development in Africa, our other stakeholders are equally as important. These are our staff. These are the citizens of this country, the governments that rely on oil and gas production in these countries, helping them also to invest in the longer-term energy transition. So it's a point that I think is very, very important to make in this ESG world and the focus on ESG, that oil companies actually do have an important role to play in the transition and in economic development in countries in which they operate. So here's a slide that I think talks a little bit about why I think we're an interesting company at the moment. Now, I don't know about your view of oil prices. We can see that they're about $88 a barrel now. Some people are saying it's going to 100. Some people are a little bit more bearish. But nonetheless, if you take for granted that the oil price is strong now, we're in a very strong commodity cycle, and I personally think we'll be there for a number of years. You want a company, if you're going to invest in an oil and gas company, you want a company that has a number of attributes, and I think we've got them, and I think we're very well positioned to start distributing returns to our shareholders in the form of cash dividends. So if I start from the blue on the right and work my way around clockwise, we have long reserve life assets that are low-cost barrels. We have excellent operators. These are private equity-backed operators that are operating these fields, are entirely financially aligned with Panoro. We have very favorable taxation terms in the countries in which we operate. Moving to the green, we have a lot going on in the company. So we don't just have the reserves, we're actually producing them and developing them. So you can actually see through the top line and the bottom line that's coming through our financials that we are investing money and we're producing oil and gas, and that we very much focus still a little bit on exploration, but not long life exploration that can be tied into production quite quickly. If I move to the yellow, we are housed in a company that is very well governed. ESG stands for three different things, and one of them is governance, and we are very, very strongly governed, very strong board and comprising Norwegian nationals as well. We have a very, very modest amount of debt. We're not highly levered at all, and so we're very, very well set up. We're fully funded. We have no need for additional capital. And lastly, this is what I'll touch on a little bit more, we have visible production growth. So we have a diversified production base coming from lots of different places, so we're not beholden just to one place, and that we are bringing a very, very high exposure to the oil price. We're largely unhedged, so we're enjoying all these high oil prices at the moment, and we are on an upward trajectory in terms of our production. That slide kind of sums up the overall picture, but I'll get into a little bit of detail here, and this is, again, the most important point. If I go back to when we originally presented at Nordnet, we are producing here 2018 around 1,300 barrels a day. And as you can see, we're moving up the ladder. And at the exit of last year, in the blue there, you can see we produce around 8,500 barrels a day, which is about 4 times higher than the previous year. And we are on track with not just an aspiration, but plans that are firmly in place to take us during 2023 to over 12,500 barrels a day. So we're seeing a 6-fold increase in a period of 2 years in terms of our production base, right at a time when the oil price is going through what we think is going to be a sustained high macro cycle. So this is my final slide, is just to reiterate some of the points I've already made, but these are important ones. We've made some acquisitions earlier this year, which we'll touch on perhaps in some of the Q&A, which has allowed us to have that production growth. And these assets we bought when oil was $45. So we've been very opportunistic and bought high-quality assets at a time when the industry was hurting, and we've made a very, very good trade there, which has really transformed the company. Our assets are very, very low cost and diversified, so that means we can withstand even periods of low oil price. We don't think that's going to happen, but if it does, we have assets that can sustain themselves in bad times as well as good. We have a visible growth profile, so that production base that I talked about going up 6-fold from a year and a half ago, and that's all on track. We're in a very strong financial position with very high margins on our business and a strong balance sheet. And all of that means, going into the final point there, the green, is that we are set up to return cash to shareholders. We had originally anticipated paying cash dividends to shareholders in mid-2023. That's what we announced about a year ago when we made these acquisitions. Given the strong macro cycle and given the performance of the assets that we've got, we are in a position now to bring that materially forward. We've not yet announced when we will commence dividend payments, but there is every chance that we're materially going to bring forward that first dividend date. And the cash generation coming out of the company will demonstrate that. As an example, over the next 3 years, we should be generating in free cash flow more than our current market capitalization. So in 3 years, at these oil prices, or even slightly lower, we'll generate at least, if not more, than our entire market capitalization. At the end of 3 years, we should have almost as much cash on our balance sheet as our current market capitalization. So it gives you an idea that in a long-term business with long-term reserves, we're going to be generating a lot of cash at these oil prices, even lower oil prices than this. And we fully intend, through our strategy, to return a considerable more amount of that cash to shareholders. So, Roger, that was it for my presentation. I will gladly take questions now.
Yeah, thank you for the presentation. John, we will now go straight into the Q&A session. I've prepared 7 topics. First of all, I want to touch upon the core strategy of yours. So for you, as I see it, your top priorities are, first to extract more oil from existing fields, to explore near your existing infrastructure, to make small, attractive acquisitions, and finally, of course, to deliver cash returns, dividends as soon as possible. So could you please elaborate on why is this the optimal strategy for your company?
I've been around the oil and gas business for a long time. I've been an investor, I've been a banker, I've been an executive, I've been a non-executive. So I like to think that I've got some perspective on this. And my own view is that the successful model for an oil and gas company of our size, or even slightly bigger companies is the days are gone where companies are going to the stock market asking for money all the time to possibly drill a well sometime in the future to pay their costs or pay down their debts. I think the model that works now is a combination of shareholder returns and growth. I think if you just have the one, it becomes quite boring. If you just have the other, it becomes a little bit too exciting, if you know what I mean. We're trying to strike the balance between being a reliable producer of oil, returning cash to shareholders, but still maintaining a growth trajectory. That growth trajectory has really helped transform the company. And we feel that we have the ambition and the capability and the setup and the platform to grow that business further. It's got to be done with the right type of deals. But I think that mix is the one that as we enter the energy transition, we're recognizing that the energy world is changing, that oil and gas has a very, very strong role to play, depending on your view of the world, but certainly for a number of years to come, has a strong role to play in that transition. So our strategy is very much built on recognizing that transition, so therefore returning cash to shareholders, but at the same time sustaining the business to make sure that it has a longevity to it and it's got a 5, 10, 15-year future ahead of it no matter what happens. So it's keeping that in balance rather than trying to be too extreme in the other direction, which I think over time those type of strategies can work in certain stock market environments. But we need to set ourselves up not only for the current stock market environment, but also for the energy transition. So that balance, I think, is absolutely critical for us.
Yeah, and especially in the macro environment of today, where interest rates are going higher, and so cash today is really valuable. So you are, I guess you are more in a sweet spot.
I think we're in a sweet spot, and the oil industry, the publicly traded shares have not been in a sweet spot from a perception perspective for the past couple of years. What we're finding now, and it's only anecdotal, we're starting to see people, funds that had previously said, well, look, we're only investing in renewables, we're out of oil and gas, starting to revisit it because the fundamentals of the industry are so strong now. We have, a lack of supply coming on, an underinvestment, and arguably an underinvestment in the renewable investment. So at a certain point, we find ourselves increasingly, people that had maybe stayed away from oil and gas for the past couple of years are starting to look back at it. And then if you're looking where can you invest, you want, as you said, we're in a little bit of a sweet spot. We've got a growing production base and a good, solid and macro environment, and we have a very solid balance sheet. So I think we are in a sweet spot at the moment.
So the visibility is quite high.
Correct.
Yeah. So, okay, let's go back a couple of years, or maybe some more years. The oil majors, they have been very active sellers.
Yes.
Of what I see, high-quality reserves at relatively low prices. And it's all due to this major strategy shift, the ESG, or going into green projects. In retrospect, should you have been more active during the last period, or have you maximized the situation?
It's a great question, and you always need to look back and try and judge yourself there. I think we've been quite successful is the truth of it. Could we have done much bigger deals? Perhaps, but don't forget we've been dealing with a macro environment which has been very volatile. Oil prices during COVID, and it's been quite a volatile time. So we've done 2 transactions with majors. We bought assets off of OMV, and then last year we announced the acquisition of 2 assets from Tullow, one in Ekvatorial-Guinea, which is a new country entry for us. This is a very, very good country with oil majors are all involved there. Exxon, Chevron, Hess, Marathon. Hess have sold out since. And we ended up buying an asset there from maybe not a major, but from a larger oil company. We were able to do that at a time when oil was $45 a barrel. And what we found now that asset is now our most important asset in the company. It's producing 60% of our barrels that we produce now. And we were able to take advantage of that opportunity because of 3 things. One was we had the strong support of our existing shareholders, said, look, take advantage of the opportunity. We see, the big drop in sentiment to the sector and the drop in the oil price. Let's try and do something about it. We had very strong support from some of our financial stakeholders, and we had very strong support in country from these countries that are recognizing now that there is a changing of the guard. The larger companies are leaving, the junior ones are coming in. But those junior companies need to be ones that have good governance and can work together with the governments. In Equatorial-Guinea, for instance, we've found that absolutely. That trend is always been there. Oil companies have always selling assets to smaller companies. That trend has been here ever since the oil industry existed. But it's being accelerated, as you say, by the energy transition. And we can talk a little bit about maybe our strategy around ESG. I'm not sure you have a question on that. Perhaps everybody usually does. We'll come back to that one. But our positioning is very much, having done these two deals, we're moving up that food chain. We're now suddenly much more in the focus of these major companies saying, well, maybe we should give Panoro a call for that one. So I think, could we have done more? We can always say we have, but we have taken advantage. We've done two big deals for the company that have, again, transformed the company to 5-6 times the production, 3-4-5 times the reserves. So we have managed to do those transactions, but I think there's more to come.
Yeah, and that's the skill sets of the management, I guess, and I have some follow-up question on that later in this session. I want to talk a little about cash dividends. The cash dividends are soon to come.
Yes.
But today the oil price is around $90, I guess. But how confident are you that today's prices will stay at least at these levels for the next 2-3 years?
We have all our financial models. We sit there and look at our financial models every day. I don't dare to even put anything with an 8 in front of those financial models. It's, when we're dreaming, you put a $70 oil in there. So we're in an environment now where the oil price is certainly at the front end. We're in backwardation now, but it's certainly the front end is far higher than most people thought. Myself, however, I think there's always volatility in the oil and gas price, but I think we're structurally in for a period of higher oil prices. Now, whether that's 100 or 120 or 80, I don't know, maybe even 70. But in that band, I feel we're in a multi-year period where oil prices remain high, and that's predominantly because of the underinvestment that we've seen across the world in oil and gas. Now, the U.S. shale can, of course, start picking up again, but there's a lot of financial discipline that's been put into the U.S. shale business now, so I don't think we're going to see shale come back as strong as it had in the past and serve as a dampener to that oil price. So I'm quite bullish on it, and I think that the world is getting used to higher energy prices. We're seeing what's happening in the European gas markets. Now, we're in Africa, so we have nothing to do with that necessarily, but you're seeing what's happening to energy prices around the world as we get into this underinvestment in oil and gas and not enough money yet coming into the renewables. Somewhere in the middle, there's going to be some pressure on the prices, on the core hydrocarbon prices to remain high. So I'm quite bullish. I don't dream of extremely high oil prices because I think ultimately that's also can be destructive. But in and around here, I think is a very good sweet spot.
And of course, if you look at the historic volatility in the oil market, I guess for Brent, there's 20 US dollars in both directions within a year.
Yeah.
So the volatility most likely will stay high.
I think it will, but you can see structurally we're quite high. I don't know what's going to happen. None of us do. All we can do is plan for the best, make sure operations are as lean as they can be.
And your strategy, core strategy, you don't do much hedging, do you?
At the moment, we're almost unhedged. I think we have less than our 10% of our production hedged. We always try and do a little bit of hedging in and around to make sure we don't get caught out if we're lifting some oil and selling some oil that suddenly on that day or that week it's a bad price. So we will be doing some hedging, but at the moment we're entirely exposed to what you're seeing on the screens now. I think we're 93% unhedged at the moment.
I see. So do you believe the world economy can thrive in a $100 barrel environment given the strong dollar of today?
I think that it's going to have to. Again, we're seeing energy inflation. We're seeing inflation, period. But we're seeing energy inflation across the board now. And is it just because we're having a cold winter and we're having some issues east of us here, or is this more structural around the lack of investment in, for instance, European gas? So I think that it's going to have to. I think energy prices are going up. Cost of renewables, the subsidies that come in with that, the cost of gas, now the cost of oil. I think that it will get used to $100 oil if that's where it's going. Obviously, again, I don't wish extremely high oil prices on the economies of the world. But I think that people are going to have to get used to higher energy prices.
Yeah. So the main thing is that the world economy don't go into recession.
Correct.
Yeah.
Correct. That's not good for any of us.
So for my part, I'm back at school. I studied both finance and macroeconomics, and I'm quite fond of macroeconomics. And if you go back into the 80s, to the 90s, and the last 10 years, there has been extremely technology push in the economy. And if you look back, there has been always a follow-up with better growth than expected the next 10 years. So maybe you will be right. We'll see. Risk factors, they are essential. So from an analytical perspective, it's more or less the most important thing. So there are many advantages being as small and nimble as you are. A market capitalization, you said $300 million or approximately 3 billion NOK. But there are many disadvantages as well. Can you give us your thoughts on some factors? Also, can talk about cost control, overall diversification, financial strength and lifting capacity when it comes to M&A activity, and last but not least, the human resource part.
Yeah. I think maybe one way to answer the question is to talk about kind of where we were a year or two ago and where we are now, because I think that highlights some of these risk factors you're talking about. So, if you look at your cost structure of running the business, we have a very lean and mean organization. We really have kept this company very, very small. Now, the risk there is that you still, as a public company, you still have a set of costs that you can't get away from. And if your production and your cash flows are quite small, if you're a small company, those kind of are outside, they're quite heavy compared to the rest of your P&L. What we've done through these transactions is we've had to grow the company a little bit in the cost base of the company, but we've transformed the business, made it 3 or 4 times, 5 times bigger. But because kept the cost base, it's not even gone up, by a factor of 2. It's gone up maybe by 30-40%. So we've addressed that risk through growth. So we've kind of been able to keep that cost base now into a modest proportion. 2 or 3 years ago, we had exposure to 2 oil fields and 2 different partners. We now have a much bigger asset base. So if something goes wrong in one, you've now got, for instance, I told you we've added Ekvatorial-Guinea. Now we have another big asset. That's our largest one at the moment. But Dussafu is going to catch up to that next year. So you have, through that diversification, you've dealt with some of the risks that are inherent in this business, as you're exposed to a country or to a taxation regime or to something happens on the operations, or if something happens, with the geology. By diversifying your production base and your asset base, you're able to get away from some of those risks. You're never going to completely get away from them, but you've mitigated the risk that one of them is going to really hurt you badly. So I don't know if that answers your question exactly, but I think, cost base, diversification, these are kind of the core risks that we see. And human resources, there's been a big exodus from the sector. Fewer young people are coming into the sector. It's not as interesting as it used to be to join the oil sector. But there's a huge, still generations of very, very highly skilled people out there that know what they're doing in the oil and gas business. And it's up to us to continue to attract young people into the business and to make use of the people that are there. So we're not finding human resources to be a major constraint at the moment.
No, because the wisdom part of this...
The wisdom is there.
Yeah.
The wisdom is there. And people have been working in this industry for 30, 40, 50 years, and they're still there.
Yeah. Fourth quarter is it's over. We can't talk about that, obviously. But third quarter numbers, can you give us some insights into your operations back in Q3?
Sure.
And did everything go as planned?
Sure. One of the things that we wrestle with a little bit in our communications is that our business we have to report quarterly, but a lot of times the big events that come through your P&L, for instance, or your cash flow statements in the quarter, they can be quite lumpy. If we're not selling a cargo of oil in a certain quarter, the revenue is quite low. If we're selling it the next quarter, suddenly the revenue is very high. So I prefer really to look at 6-month or 12-month trends in the business. Third quarter was not terribly eventful. There's not a huge amount to report there. But I think what is important to walk away from when looking at our third quarter report, and we'll be doing our fourth quarter in about a month, is that we're on a trajectory. We're on an inflection point where production is increasing. Oil prices are increasing. We can't control that, but we can control the other. Our production is increasing, and we have full visibility on the next 18 months in terms of where we're spending our money, where the new production is going to come from, the timetable that it's going to happen in. And I can report that everything is on track in terms of those expectations that the market has set out for us. So for us, it's really about keeping our heads down, bringing that production growth. We'll probably produce, in 18 months from now, we'll probably be producing 50% more than we did in 2021. So there's a real production growth I showed in that one slide that's coming. And all of that is not aspirational. That is all planned. And the message coming out of the third quarter and the same message coming out of the fourth quarter is it's all on track. You're starting to see the production growth already in our fourth quarter numbers that we already pre-announced a little bit. So you're already starting to see it happen. And I want to be judged in 2022 on seeing that production come along just as we said it was. And towards the end of next year, when it really starts going up, that happens on time and on budget. And I think those are the key things that most shareholders would be looking for, making sure that progress is there and that progress is leading to one thing, which is shareholder returns.
And talking about shareholder returns, one big factor, major factor, is the underlying margins of your business. So by dissecting your current valuation, attractive underlying margins are made visible, in my view. So, but are you satisfied with current levels, or can you improve further?
On our operating margins?
Yeah.
The operating margins in our business are largely fixed. You have usually a big FPSO out there that's on a lease, it's on a fixed. So the bulk of your costs in operating in our case is a fixed cost business. So what we always try and target are low cost operations. When we're looking at new assets or indeed the running of our businesses, we are looking at low cost operations. And don't forget, our operator in Ekvatorial-Guinea, Trident Energy, is a private equity backed vehicle. Our operator in Gabon, BW Energy, is sort of a quasi private equity company in terms of its management team. Everybody is absolutely focused on cost control. So I don't think that there's lots we can do to kind of lower that. What I would say is that,
but you can maintain these levels.
We can maintain these levels. So the way I like to look at it, if oil is, say, $70 a barrel, or 80, after tax and after operating costs, we should be making about a 50% margin after tax. So that means, if oil is 80, that means we're making $40 a barrel. If oil is 70, we're making 35. It's not quite right, but it's directionally correct. And that is a very, very healthy margin. As a post-tax margin, that's very, very, very healthy. So again, getting back to our free cash flow over the next few years, I can easily see us getting to our market cap or much more, frankly, in the next 3 years. And that is through maintaining that low cost operating base. I don't think we can probably improve on it much. On a unit cost basis, it will go down because as we're increasing production, it's still a fixed cost OPEX. So on a unit per barrel basis, it's going down. But as a total amount, it's probably staying the same. But the first one's more important is what is your unit cost per barrel? And that's going down because you're putting more production across the same fixed cost base.
We have to touch up on the ESG part. It's important. From my point of view, getting your environmental, social, and governance, also ESG proposition right, will most likely lead to higher valuation down the road. So, what's your ESG proposition at Panoro Energy?
It's a great question, and it's one we obviously increasingly get asked more and more. We look at it, we're an oil and gas company. You can't get away from that. That is what we do. We produce hydrocarbons, which are obviously in the center of this entire debate. However, we've been very articulate in also talking about the energy transition and our belief in the energy transition. And what is our role, therefore, as an oil and gas company in the energy transition? And it's very much focused around ESG. Of course, ESG stands for environment, but it also stands for social and governance. The social and governance aspects we really try to take care of. We have an excellent board. We look after our staff and the societies in which we work, our corporate social responsibility. So I'll leave that to the side for the moment, but those are equally as important as the whole environmental aspect here.
Absolutely.
But the way that we look at the energy transition and the E part of ESG is that oil and gas is here to stay for a little while. It's hopefully diminishing in terms of its balance of the overall equation, but it's still here. With larger oil companies divesting these assets, sometimes these are more mature assets, the ones that are actually probably the most carbon intensive as well. These are the ones that the larger companies want to get rid of. But they're not shutting down these assets, they're selling them.
Yeah.
So who are they selling them to? Our position on this is we want to be an extremely credible and well-governed entity that can absorb some of these assets, not all of them, but some of them, to run them better from a carbon efficiency perspective, in terms of the transparency of what's actually happening, to be reporting those, and to where we can, to try and reduce that carbon intensity, and to be a good custodian of these assets, which are still absolutely critical to the energy transition, but also to the countries in which we operate. So our stance on the E part of ESG, because the S and the G are equally as important, but get talked about less, but is we need to be a responsible custodian manager of these assets, which are important to the host countries, taxpayers, the employees that we have, but also our responsibility towards the global transition and managing those assets in a proper way, rather than, for instance, the assets being sold to somebody else who maybe doesn't care about those things.
So this, in the end, this is a balancing act for everyone. Somebody has to, make the production running.
Correct. I mean, the other option is just to shut down the production, which some people would of course argue may be the right thing, and in some cases they may be right. But generally speaking, there is a transition going on here, which requires the oil and gas industry to continue to produce oil and gas for a period of time. You can debate that period of time, but it is going to continue to produce. Somebody needs to manage those assets. Who better than a well-governed Norwegian company?
So being trustworthy, keeping your integrity high is maybe the most important part here.
Absolutely, and that's towards all stakeholders, the shareholders that we're talking to today, but also importantly to the host countries in which we operate. These are absolutely critical assets to these developing economies in Africa. We're not operating in Norway. We're not operating in the UK North Sea. We're operating in Africa, where the energy transition gets talked about, but energy security is actually far more important to them at the moment, because their lives, their livelihoods, their daily lives depend on it, much as it does for us here in Northern Europe, but in a much different way in Africa. That energy security is absolutely critical, and that's the debate you hear more often than energy transition when you go to Africa. Energy security is just as important as that energy transition.
Yeah. So I have one final topic. I think it's open for you. It's a concluding remarks. So what makes Panoro Energy a worthwhile investment in your view, John?
Well, I'm not much of a bragger, but what I would say is, this is our third time now in Nordnet. If I look back on it, Panoro was a little bit of a special interest case. It was a small company. It had some restructuring it needed to be doing. We believed in it. The same team is there. So we've had continuity of the people. The board has stayed the same. The management have stayed the same. And we have been entirely focused on transforming this company. And you're starting to see now the fruits of that transformation and that hard work, where the company is now no longer a special event company. It is a oil production company with a very modest leverage, so a very healthy balance sheet that is increasing its oil production at a time when oil prices are at a not an all-time high, but certainly at a recent high, with the intention to do the right thing by our shareholders. We are entirely aligned with shareholders. Everybody on the board, everybody in the management are shareholders. Our chairman himself is one of the largest shareholders of the company. So that alignment with shareholders to deliver value to shareholders and cash return to shareholders is paramount. So we've got the company to a place where it's very, very stable. And if oil prices stay high and our operations, our diversified operations, do more or less what they think they will, this company is going to be rock solid for many years to come.
Yeah, and that's very good for, I guess we have 3,000 of our clients have a stake in Panoro Energy, and they are not in correction territory.
No. Obviously, we had a good year last year. We did the big acquisitions. We issued some shares at 15. We're trading at 23, 4, 5, something like that at the moment. So I think the market has recognized that we have changed this business. And for me, the most important thing is the markets will always be volatile. Oil price will always be volatile, but we've created a platform in which that volatility can be diminished by virtue of the strength of the rest of the organization.
Yeah. And lastly, what will be your main priorities going forward?
Main priorities is to do what we've said we're going to do, which is to put this new production online, pay cash dividends to shareholders, and continue to look at accretive growth. We showed last year that we were able to do very, very accretive deals for shareholders. And again, our share price reflects, I think, the market recognition of that accretion. To continue to look at that and to be a partner of choice for the African governments and for potential disposers of assets, that we can responsibly jointly manage these important assets going forward. So the plan is very much to do everything we've said to our financial stakeholders, but also to our other stakeholders as well.
Yeah, very good.
Thank you.
Okay, John, that's all for today. Thank you for your time and your presentation and your insights. We'll keep in touch.
Thank you, Roger.
Hopefully in maybe 6 months' time or so.
I'll come back.
For those of you who want to learn more about Panoro Energy, please visit panoroenergy.com. The company shares are traded at Oslo Børs on a ticker PEN. Goodbye, everyone.